Forward conversion with options is an equity monetization strategy that can be used by holders of concentrated publicly traded stocks. It is effectively a synthetic short forward position that can be used to transform the share's position into a synthetic risk-free asset. So in this strategy, the holder of the shares will purchase a put option and sell a call option with the same exercise price and the same maturity date, and that will effectively convert this entire position into a risk-free asset. And from there, since it's a risk-free asset, the holder or the shareholder will be able to take out a loan with a high loan-to-value ratio. Okay, so that allows the monetization of the equity position. Now, some may ask, how is this a short forward position? Now, if we bring this back or we try to recall the put-call parity, then it will be easier to link. So in the put-call parity, the value of a protective put, if you buy a put, a long put, and a long underlying or share position is equals to a long call and a long risk-free bond. Now, in this case, if you long a put, okay, if you long a put and you short a call, this will be equivalent to the value of the risk-free bond minus the value of the underlying share. Now, if you look at this particular payoff, okay, this is similar to the payoff of a short position in a forward contract, where F represents the forward price of a forward contract. So that's how it's a synthetic short forward position. Now, on to the next part. How does this strategy convert it into a risk-free asset? So if I were to rearrange this shares, okay, shares and a long put and a short call. So in this case, if I transform this shares and a long put and a short call, that will only leave us with the risk-free bond, which is this x over 1 plus r power t. So by doing this, we are effectively converting the position into a synthetic risk-free asset. And since it's a risk-free asset, therefore we will be able to take out a loan from the bank. So when you show the bank that you have this position, then the bank will know that the value of this position will be very stable. So they'll allow you to take out a loan with a higher LTV, probably say at 90%. So in other words, if the shares is worth $10 million, you'll be able to take out a loan of $9 million. Okay? But if you were to just take the shares, okay, without doing all this forward conversion strategy, if you were to just take the shares and pledge it to the bank to take out a loan, the bank will probably say 60 to 70% LTV for you. And the interest rate could also be higher. But for the loan with the high LTV, since it's risk-free, the bank would probably charge a lower rate compared to if you just take the shares and pledge it to get the loan out. So by doing this strategy, you'll be able to maximize the amount of cash that you can monetize through the loan. And this cash can be used to diversify your portfolio holdings. So on one hand, you can actually reduce your concentration in the publicly traded stock. Okay, you don't have to sell the stocks, which helps you to avoid or defer the capital gains tax, and you'll be able to monetize or convert this into cash, which you can use and invest into, let's say, a stock market index.